Well, it's that time of year again. The IRS has released the numbers for 2026 tax years, but there's actually been some changes even to 2025's tax year numbers due to the passing of the One Big Beautiful Bill. That also affects next year's tax numbers, so today let's go over some of those changes as they relate to our estate planning world. We're going to go over the standard deduction, estate taxes, and gift taxes. Let's start with the standard deduction. For tax year 2026, the standard deduction increases to $32,200 for married couples filing jointly. But for single taxpayers and married individuals filing separately, the standard deduction raises to $16,100 for the next year. And for heads of households, the standard deduction will be $24,150. Additionally, for this tax year, 2025, the One Big Beautiful Bill raises the standard deduction amount to $31,500 for married couples filing jointly. For single taxpayers and married individuals filing separately, the standard deduction this year is $15,750, and for heads of household, the standard deduction is $32,625. Now, that's great and all. That's for our normal income tax purposes, but as they relate to our estate planning world, the main ones we are really concerned about are the estate tax and gift taxes. So next, let's talk about the estate tax. As a reminder, the estate tax is a tax paid by your estate after you pass away. Now, not every estate is going to pay an estate tax. The estate only pays that tax if it's worth above a certain threshold. This year, for 2025, that threshold is the whopping $13.99 million. And again, that is per person, not just necessarily per household. That number is increasing yet again next year. Next year, 2026, the estate tax threshold is going to be $15 million even. That means unless your estate is worth $15 million or more, then your estate will not have to pay an estate tax. And as a side note, the estate tax is also called a death tax. Estate tax, death tax, it's the same thing. And this is all at the federal level. Every state can go and collect their own estate tax. For us here in California, we don't even have to worry about it. State of California does not collect an estate tax. Most states don't, actually. The next tax is the gift tax. This one crops up in the estate planning world for lots of different reasons. It does play into a lot of different estate planning strategies, but it is one that also crops up in a lot of everyday scenarios. What if you give a gift to somebody? Do you owe a tax on that? The gift tax is a tax paid by the giver of a gift, not the recipient. If the giver of a gift gives over a certain amount, then they, the giver, owes a tax on that gifted amount. If you give above the exclusion in a year, then you owe a 40% tax on that overage of the exclusion amount. So the question then becomes, what is that exclusion amount? So this year, 2025, that exclusion amount is $19,000. Now that amount has grown over the past few years, but for 2026, it's actually going to stay the same, $19,000 per recipient. So what that means is if I give $19,000 to person A and $19,000 to person B, doesn't matter if I give that to them in this year, 2025, or next year, 2026, no gift tax would be owed. However, if I gave $25,000 to person A and $19,000 to person B, I would owe a gift tax based on that gift I gave to person A, because I gave them over $19,000 all in 1 year. In that case, $25,000 minus $19,000, which means I owe a gift tax of 40% on that $6,000 overage. On a side note, there is an annual exclusion for gifts given to a spouse who is not a citizen of the US. That annual exclusion for gifts given to non-citizens increases to $194,000 for calendar year 2026, which is up $4,000 from where we're currently at right now. So again, that's in a more niche scenario. Gift between spouses where the receiving spouse is not a US citizen. Where gift taxes comes into play in the estate planning world is when we want to lower the value of somebody's estate while they are alive. And typically this is done to either lower their value so that they fit under the estate tax threshold, or where we want to lower the value of their estate in order to conform so they can receive maybe some sort of public benefit For us here in California, we're typically talking about medi-cal in that case. Last week, I did a video talking about how the medi-cal system in California is changing dramatically, and most of that centers around how we even get people qualified for medi-cal in the first place. In that video, I discussed that we don't quite know the numbers fully yet, but right now it's looking like if you have assets exceeding $130,000, then you have too many assets in order to qualify for medi-cal. However, the average nationwide cost of a nursing home is getting close to 10 grand. So what are we supposed to do if we have, say, $200,000? Well, while you could spend 70 grand of that just paying for the nursing home, instead what you can do is move some of those assets out of the person's estate who's going to need the help and get them qualified for medi-cal, something they've been paying into their whole lives, to help pay for the cost of that nursing facility so we don't have to impoverish their estate just to get them the care they need. The way we do that is we need to gift some of that money away in a particular way, the way medi-cal designates for us, but we gift some of that money away to maybe a trusted friend or usually a trusted family member. Now, in a case like that, we have to be extremely wary of what the current gift tax exclusion is at. Again, as long as we gift below that amount to a person within a year, we don't pay a gift tax on it. We don't even have to tell the IRS we did it. But going back to my example, we've got 70 grand at least that we need to move out of someone's estate. They have 200 grand, they need to be below 130. So what do we do in that scenario? 70 grand is, of course, more than 19 grand. Well, they could gift 19 grand to a couple different people, but let's say we don't want to be spreading all that money around and we still want to reserve some of that for our own care. So instead what we do is we gift that money just to one person all in 1 year. So that $70,000 moves out of my estate entirely. Question is, how do we avoid a gift tax on that 70 grand? I don't want to be paying a 40% tax on the money that I gave to my own family. So the way we do that is first, of course, we're going to exclude the first $19,000. That's our yearly limit. We can give that without even having to tell the IRS we did it. Going beyond that though, the overage, what I want to do is tap into my estate tax exemption early while I'm alive. As a reminder, the estate tax exclusion for 2025 is $13.99 million. 2026, it's going to be $15 million. So I have $15 million of wiggle room to tap into while I'm alive and still not pay a gift tax. So the way it works is we tap into our estate tax exclusion amount, the $15 million, and say that that is our lifetime exclusion amount for gifting in total. So I'm tapping into that $15 million pool early while I'm alive, knowing full well I don't have $15 million. I'm never going to have to pay an estate tax. So I want to tap into that exclusion early, gift 70 grand away in a year, for example, and still not pay a gift tax. Now, again, we don't have to tell the IRS we made that first $19,000 gift, but anything beyond that, we just have to tell the IRS we're going to do it and that we want to apply it towards our lifetime exclusion, $15 million. And the way we do that is just file the appropriate forms with our tax returns in the year in which we made the gift. So for example, if I gave that money in 2026, then I'm going to file Form 709 with my 2026 tax return. That 709 return is going to tell the IRS I'm applying some of that gift towards my lifetime exclusion, therefore, don't charge me a gift tax. Under the One Big Beautiful Bill, there are a lot of changes to the tax laws. But relevant to what we're talking about today, in the estate planning world, our main ones are going to be the estate tax exclusion and our gift tax exclusions. Our estate tax exclusion is how much we can have and pass on before an estate tax is owed. Next year for 2026, that's $15 million even. The gift tax is how much we can give to somebody in a year before having to pay a gift tax. That number actually stays the same. $19,000 in 2025, and it'll be $19,000 again in 2026. However, we can gift more than that 19 grand in a year. We just have to tell the IRS we're going to do it and apply it towards our lifetime exclusion, essentially tapping into that estate tax exclusion amount early. So that means we're going to tap into that same number. So for 2026, our lifetime exclusion for gift taxes is going to be $15 million. Again, all that sounds like a lot of money and more money than most people think they actually have. But when it comes down to it, once you start adding a lot of things up, particularly for older folks who have a lifetime of accruing assets, and they need to qualify for long-term care, such as medi-cal in California, they're going to have to move some of those assets out of their estate. And the way we do it needs to conform with both what medi-cal wants us to do and what the tax laws are at the time. Now in that scenario, I would never suggest you do it on your own. You need to do it in consultation with an attorney and with a tax accountant in order to make sure everything's done correctly. So those are the changes under the One Big Beautiful Bill for the 2026 tax year, at least as they relate to the estate planning world. Let me know if there's anything else you want me to cover, anything you think I missed. Let me know down in the comments below. I'm attorney Andrew Bethel, and I'll see you at our next meeting.